Welcome to the San Marino Business Partners first investment classroom, and we're going to talk about inflation and investing. And you may think that's a little odd. Why do we start with inflation? Well, the reason is this. People don't consume dollars. They consume goods and services. But investments pay off in dollars. So if you make an investment today, hoping to consume goods and services in the future, you first get dollars, which you convert into those goods and services. Because of this conversion between dollars and goods and services, you have to understand inflation and investing. And that's what we're going to look at now. So let's get started with some specifics. So, why do we invest? As I said at the introduction, it's because we want to consume future goods and services. We want to pay for future consumption. And what do I mean by future consumption? Well, let's just look at some examples. One may be to fund your college education for your children. Another may be to plan a unique family vacation. A third may be to fund your own retirement. Or you may even decide to invest because the opportunities just look so attractive. If you're willing to forego consumption today, you'll be able to consume a lot more in the future. So what investing is foregoing consumption today and moving it into the future. But to understand how that works, you need to understand the purchasing power of the dollar and how dollars get translated into consumption at different points in time. I'm going to go through an example that I think will help you understand what inflation really is. And people tend to think of inflation as increasing prices for goods and services. But it really isn't. It's not that prices are going up. It's that the value of the dollar is going down. And to illustrate what that means, I'm going to deal not with the measure of value, which is the dollar, but a measure of distance, which is the inch. So suppose we have this pencil here and we want to measure how long it is. Well, I'll bring up a ruler, and you can see that it's about 5 inches long. Now I want you to imagine that some evil force somehow is able to shrink the unit of measurement, that the inch itself gets smaller. Well, how would we know this was happening? Since the unit itself is changing, there'd be no way to see what was happening except by measuring things. Let me give you the example. Now the inch is shrunk. So the ruler is shorter, and when we measure the pencil, it's now over 6 inches long. It's not that the pencil has gotten bigger, it's that the inch has gotten smaller. But the way we would experience this, if we believe that the ruler measured distance, is we would experience it as everything getting bigger, like our pencil. You'd be taller, cars would get better mileage, and so forth. And as the inch continued to shrink, distances would continue to expand. Another year later, for example, our pencil might be 7.5 inches long. And you can imagine if the inch was shrinking, some of the problems it might raise. For example, what would architects do? They'd draw a set of plans, and the next year everything would be bigger, so the plans wouldn't work. And so architects would scratch their heads and say, every year the plans have to be changed. And then some smart architect would say, well, why don't we define the year 2000 inch? And we'll measure everything in terms of the year 2000 inch. And then we won't have to keep changing everything. Well, you might say that's ridiculous. Why invent the year 2000 inch? The inch doesn't shrink and so forth. And you're right, it doesn't. And so we don't need a year 2000 inch. But the dollar does. The dollar has been shrinking virtually every year since the Revolutionary War. And in fact, economists and government policymakers have invented the constant dollar, the year 2000 dollar. So the problem we face when we talk about inflation is not prices going up generally, it's the dollar shrinking. And as the dollar gets smaller, it buys less and less, and we experience that as rising prices. So in my example with the shrinking inch, as the inch got smaller, everything got bigger, and everything increased in exact proportion. You'd get taller, the pencil would get longer, the distance was that you have to drive would increase, but so would mileage by exactly the same amount. But you might say, now wait a minute, the shrinking dollar doesn't work like that. The dollar's been shrinking, you said, since the Revolutionary War, and it's been shrinking. We're going to look at a lot of data in these lectures from 1960 on. It's been shrinking virtually every year since 1960. But all prices aren't going down. Let's look at an extreme example, the price of hard disk space. Here's an ad from the 1980s saying what we've been waiting for, a 10 megabyte hard disk for only about $3,400. Well, here's a more recent ad from Amazon, a 2 terabyte or a $2 trillion megabyte disk on Amazon for $75. So if you want to compare apples to apples, what's it cost to buy a megabyte? In the 1980s, it cost almost $400. Today, it costs less than 1/100th of a penny. So you say, well, what happened to the shrinking dollar? And this is what makes inflation hard to measure. Prices in the economy serve two purposes. One purpose, the most important purpose, is that they balance supply and demand. So if there's technological improvements that greatly increase the ability to supply a good, like a megabyte of hard disk, the price goes down to balance supply and demand. If something becomes more scarce, like oil has become, the price goes up to balance supply and demand. But then what's inflation? What's the thing that we're trying to get at that's common across all goods and services? And the way I like to think about this is imagine that you're in an elevator and you have a bunch of balls that are all bouncing up and down on the elevator floor. Those balls moving up and down are like the prices in the economy changing to balance supply and demand. But the elevator itself is slowly moving up. And the rate at which the elevator itself is moving up reflects the shrinkage of the dollar and the rate of inflation. And how do you measure that? You've got to look at the average price change across all goods and services. And that turns out to be quite hard to do. The Bureau of Labor Statistics, the government entity charged with measuring inflation, spends hundreds of millions of dollars a year trying to survey exactly what people buy and how much it costs so that they can measure the average price change. And the result is something called the Consumer Price Index, which is the average price across all goods and services. And just to show you how tricky the government's job might be, suppose that one of the goods and services that people buy are television sets. Well, in 1960, a television set was a black and white box that weighed a ton and got 13 channels of reception. Today, a television set is a large flat panel screen that gets hundreds of channels and has a viewing area about 10 times as large. So if you called both a television set, you clearly would not be comparing apples to apples. And the Bureau of Labor Statistics struggles with this when it puts together the CPI in an attempt to get apples to apples comparisons. So in these lectures, we're going to assume that the Bureau of Labor Statistics is able to do its job well. And we're going to use the CPI to measure the change in purchasing power of the dollar. Because the dollar is shrinking, its purchasing power declines over time. And that's what the government is measuring with the Consumer Price Index. And as I stated earlier, we're going to look at a lot of data from 1960 through 2010. And over that period of time, the purchasing power of a dollar declined, and we're going to take the beginning point to be $1. From $1, and as prices rose and the dollar shrunk, the purchasing power of the dollar has declined all the way to 13 cents. So if you invested $100 in 1960 and still had $100 in 2010, you would have in fact experienced a very significant loss, since the purchasing power of that $100 in 2010 is only $13 in terms of 1960 dollars. So to illustrate how important this purchasing power calculation can be, let's look at the experience of someone who may have bought a home in 1960 and sold it in 2010. So let's consider an example of someone who bought a home a long time ago in 1960 and paid $50,000. And they sold that home in 2010 for $500,000. Sounds like a terrific investment. You've made 10 times on your money, though it's been a long period of time. But that's misleading. We have to worry about that substantial change in the purchasing power of the dollar that occurred in the meantime. And the way you do that, and the way economists do that when they deal with all economic statistics like gross national product, is to compute something called the real value of the sale. And here's how that works. You sold the house for $500,000. But at the time you sold it, the purchasing power of the dollar was only 13 cents compared to a $1 purchasing power of the dollar back in 1960. So to get the real sale price, you multiply by the current purchasing power of the dollar and divide by the purchasing power at the time of purchase. And if you do that, you get a real sale price of only $65,000. So an increase from 50 to 65,000 real dollars over the course of 50 years is not a very good investment. In fact, it amounts to less than 0.5% per year. And this type of calculation is what the government does, for example, when it computes GDP. It takes GDP last year and then computes real GDP this year to get the economic growth. So it's adjusting for the change in the purchasing power of the dollar. So whenever you see the term related to any investment, when someone talks about the real return on the stock market, that would mean if you purchased the stock like a home at one date and sold it at another, and putting aside any dividends or payouts for the time being, the real return would have to be computed by adjusting for the change, and in particular the decline in the purchasing power of the dollar. To show you the importance of properly calculating real magnitudes, let's take a longer view of housing prices. And this data that you see on the screen comes from Professor Robert Schiller of Yale University, who studied home prices in the United States back to when the first data are available in 1890. And all of this data is in real terms. So Professor Schiller has done exactly the inflation-adjusted calculation to today's dollars that I just explained. And the interesting thing is that if we start with housing prices of 100 in 1890, by 2000 they were almost at exactly the same level. There was a decline after World War I when new technology for building was introduced, and an increase after World War II when soldiers came home and there was a huge demand for housing. But those two tended to cancel out, so that for the first 110 years of American history, there was virtually no real housing price increase. And that's why Professor Schiller referred to this experience up through July of 2006 as a housing bubble that would not be supported. And he, in fact, turned out to be correct. And we're now back around here with virtually no real increase in the price of housing. And what this underscores is how important it is to think in real terms. When you think in real terms, you recognize that as far as price appreciation is concerned, housing is not a good investment. It may be a wonderful enjoyment for your family, and you may purchase it for that reason. But purchasing houses as a speculative investment does not make a lot of sense. So in the next session, we'll talk about where this inflation comes from, because it clearly is important in evaluating any investment.